Many business owners believe that profit means success, but cash tells the real story. A company can report healthy profits on paper and still run out of money if cash is not managed effectively. In this video, you'll learn what a cash flow statement actually reveals, how operating cash flow works with practical examples, what investing cash flow looks like in real businesses, and how financing cash flow explains where companies get the money to grow. Miss even one of these concepts, and your business could quietly lose cash without you realizing why. Let's begin with what a cash flow statement really shows. A cash flow statement tracks how actual money moves into and out of a business during a specific period. Unlike an income statement, it doesn't measure profit. Instead, it focuses only on cash that has truly been received or paid. Think of it as a complete record of your business bank account, showing every dollar that enters and every dollar that leaves. Imagine a small business sells products worth $50,000 in a single month. Customers pay only $20,000 right away and agree to pay the remaining $30,000 later. During that same month, the business pays $15,000 in employee wages, $5,000 in rent, and $10,000 to suppliers. On paper, sales appear strong, but actual cash leaving the business is greater than the cash coming in. That creates a cash shortage, even though revenue looks impressive. A cash flow statement makes this problem easy to spot before it becomes a serious financial crisis. It answers several important questions every business owner should understand. How much cash did the company's everyday operations generate? How much money was spent on equipment, technology, or other long-term assets? And how much cash came from bank loans, investors, or other financing sources? Timing is another critical factor. Cash flow depends on when money actually changes hands, not when a sale is recorded in the accounting system. Sending an invoice doesn't pay your employees, your rent, or your suppliers. Only cash can do that. That's why many businesses that appear profitable still struggle to survive. Understanding your cash flow statement helps you avoid unexpected shortages, missed payments, and unnecessary financial stress. Next, let's look at operating cash flow with practical examples. Operating cash flow measures how much cash your business generates from its normal day-to-day activities. It includes money collected from customers and cash paid for wages, rent, utilities, inventory, raw materials, and other regular operating costs. It does not include money from loans, investments, or purchasing major business assets. Here's a simple example. A business provides services worth $40,000 during 1 month. Customers pay $30,000 in cash before the month ends, while the remaining balance will be paid later. During that same period, the company pays $12,000 in salaries, $6,000 in office rent, $2,000 in utility bills, and $8,000 to suppliers. Total operating cash paid equals $28,000. Cash collected is $30,000. Subtract the cash paid from the cash received, and operating cash flow is a positive $2,000. That means the business generated real cash through its everyday operations. Now imagine a different situation. Sales stay exactly the same, but customers pay only $20,000 during the month. Operating expenses remain at $28,000. This time, operating cash flow becomes negative $8,000. The business still appears busy and profitable, but every day it is losing cash instead of building it. This example highlights one of the most important lessons in business finance. Profit alone cannot keep a company alive if customers take too long to pay. Successful businesses work hard to collect payments quickly while keeping operating expenses under control. Healthy operating cash flow is often considered the heartbeat of a successful business. Now let's move on to investing cash flow and see how it works in real business situations. Investing cash flow shows how a business spends or receives cash when buying or selling long-term assets. These assets are purchased to help the company operate and grow over many years rather than being sold to customers. Common examples include machinery, equipment, company vehicles, software systems, buildings, and land. Imagine your business has built up strong operating cash over several months. The owner decides to purchase new manufacturing equipment costing $20,000 to increase production. That payment leaves the business and appears as negative investing cash flow. Although cash decreases, this isn't necessarily a bad sign. It often means the company is investing today to earn more money in the future. Now consider the opposite situation. The company sells an old machine for $7,000 because it is no longer needed. That cash enters the business and appears as positive investing cash flow. Cash increases, but the company's long-term assets decrease. Here's another example. During the same reporting period, the business buys new equipment for $20,000 and sells old office furniture for $5,000. investing cash flow ends up being negative $15,000. This simply shows that the business invested more cash than it recovered from selling assets. The most important lesson is understanding the reason behind the numbers. Negative investing cash flow is often a positive sign for businesses that are expanding. Positive investing cash flow may indicate the company is selling assets to raise cash instead of investing for future growth. Context is everything. Never judge cash flow simply by whether money came in or went out. Always understand why it moved. Finally, let's explore financing cash flow and how businesses raise the money they need to operate and grow. Financing cash flow shows how a business raises money and how it pays that money back over time. This section includes cash received from bank loans, investors, or business owners, as well as cash paid out for loan repayments, owner distributions, and other financing activities. Let's look at a simple example. Imagine a startup receives an investment of $30,000 from an outside investor. That money enters the business and is recorded as positive financing cash flow. The company can now use those funds to hire employees, purchase equipment, or cover startup expenses while building the business. Now suppose the same company also secures a bank loan worth $20,000. Since cash enters the business, this is also recorded as positive financing cash flow. Later, the company repays $5,000 of the loan principal. That repayment reduces cash and appears as negative financing cash flow. Interest payments also reduce the company's available cash, even though they are typically recorded as operating expenses in accounting. Here's another example. A profitable business owner decides to withdraw $10,000 from the company for personal use. That cash leaves the business and is reported as negative financing cash flow. Even though the company remains profitable, its available cash balance becomes smaller. Financing cash flow helps you understand whether a business is funding itself through normal operations or relying on outside sources of money. Strong businesses gradually become less dependent on loans and investors as operating cash flow grows stronger. This section also provides valuable insight into a company's financial discipline, level of risk, and long-term stability. Financing cash flow is one of the easiest ways to identify financial dependence. If a company generates strong operating cash flow while showing negative financing cash flow, it often means existing debt is being repaid and the business is becoming financially stronger. That's usually a healthy sign. On the other hand, if financing cash flow stays positive year after year while operating cash flow remains weak, it may indicate that the business is surviving on borrowed money rather than creating enough cash on its own. Over time, that situation can become increasingly risky. Smart business owners regularly monitor how often they need outside funding and understand exactly why they need it. Financing should be used to support expansion, purchase productive assets, or seize growth opportunities, not to cover everyday operating losses. When managed responsibly, financing provides flexibility and stability during periods of growth. When used too heavily, it can hide deeper financial problems until cash shortages become impossible to ignore. Understanding all three sections of the cash flow statement, operating, investing, and financing, gives you a complete picture of your business's financial health. Once you learn how these three categories work together, you'll make better financial decisions, manage risk more effectively, and build a stronger business for the long term. If you found this video helpful, be sure to like, share, and subscribe for more practical business finance lessons designed to help you make smarter financial decisions. Thanks for watching, and I'll see you in the next video.